corporate executives right now are saying over the next 12 to 24 months, economy is going to slow and earnings growth is probably peaked, and we're heading for another earnings recession over the next 12 to 18 months.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. There's a lot of change in the air right now in the economy, the markets, and of course, with the fast approaching US presidential election. There's so much change currently underway that today's guest titled his latest report, "The Macro Winds Are Shifting." Well, how exactly? And what will the likely repercussions be? And how should investors consider positioning intelligently today for where the puck is likely headed? For guidance, we're fortunate to speak today with Jesse Felder, founder and editor of the respected market research firm, the Felder Report. Jesse, thanks so much for joining us today.
Good to be back with you, Adam. Thanks for the invitation.
Hey, it's always a pleasure. You and I catch up after, but before we turn the camera on here, and in addition to your prodigious and excellent writings, it sounds like you're just making the most of your time in the world there. You're one of the guys I aspire to follow in their footsteps. So anyways, thanks for blazing such a good trail. All right, so lots of questions about the change that's in the air right now in your recent writings. But if we can we just kick this off with the regular general question I like to ask you at the start. What's your current assessment of the global economy and financial markets?
Well, I think, that Bill Dudley put out a piece in Bloomberg recently, and he's been kind of pounding the table, arguing for rate cuts for a few months now. His latest piece was arguing for 50 basis points. And, whether we do 25 or 50, I don't think it matters too much. But I think he makes an interesting point about where we are in the economic cycle. And he talks specifically about the deterioration in the labor market. And historically, this has been something that is self-reinforcing. So, he talks about how, right, people start to fear for losing their jobs. They start to spend less. That puts pressure on corporate profits. So hiring goes down, and it just kind of becomes a vicious cycle. In his latest piece, came out yesterday, he suggests that he thinks the labor market's either crossed this tipping point or we're rapidly approaching it. So this has already become a self-reinforcing deterioration in the labor market. And I think that's probably the best estimation of where we are right now, is things haven't deteriorated enough perhaps to decisively say, yes, we're in recession, or recession's going to start in the next month or two. But it looks like we're rapidly heading in that direction. And the idea that things are just going to stop, and kind of flatten out, is against what we've seen historically, which is once these things start to turn, they continue in that direction. And I think there's tons of data to support the idea that the labor market is deteriorating in a significant way. I think, we've seen the unemployment rate tick up, but I think people really didn't pay much attention to the latest Challenger Grain Christmas report that showed job cuts in August hit the highest level for any August going back to 2009. More importantly, I think job hires, new announcements of hiring, were the lowest level year to date that the firm has ever recorded. So the labor market, and that's back to 2005. So firms are hiring less than they have done in 2 decades. The labor market's rapidly weakening, and we're seeing that start to kind of materialize in things like consumer spending. So I think we have come to the point where we've fully priced in a soft landing in the stock market. And now what we've seen over the last couple of months with the heightened volatility and things, the market may be going, wait a second, maybe a soft landing isn't, pricing 100% probability of soft landing was not such a smart idea, and having to kind of reconcile with the fact that it might not be so soft after all.
Okay, I'm trying not to pat myself on the back here, but what you're talking about and what Bill Dudley seems to be warning about is what we've talked about on this channel a lot over the past 2 years, really, year plus. And I probably to many people have sounded like a broken record, warning about the lag effect, right? That we raised interest rates very aggressively, really at a faster pace, I think, than living memory. They have held higher for longer, much longer than folks thought they would. And the warning that many folks, including myself, have said is, hey, that's not free. You eventually have to pay the price of those higher interest rates. And, you know, surprisingly to everybody, myself included, we didn't get that recession in 2023 that everybody expected. We didn't get one in 2024, at least so far. The markets have done really well. And so people got very comfortable with this soft landing, no landing scenario, and basically, I think, said largely, hey, this time is different, right? I'm going to make one or two more comments, but then I want you to say whether you agree with this or not. And even Powell himself, was saying, hey, when the Fed pivots, when we start cutting, we're going to do it early. We're going to do it before inflation gets to 2% because there is momentum to these rate cuts. And if we wait until it gets down to 2%, there may be, enough continued disinflation in the system that for our measures, the Fed, it's going to get too low, quote unquote, right? So, even the Fed itself has bought into this logic, and not surprisingly. So, another thing that I brought up a lot here to what you were saying is this chart, which is just a chart of the unemployment rate, right? And it shows for every recession, even the 2020, but let's exclude that because that's it was for different reasons. You basically have coming out of the previous recession, you have the unemployment rate trend down, down, down. It gets very quiescent. It bottoms. It kind of plateaus, and then when it starts rising, it explodes. Right. And we see that again and again and again in just about every recession in this data series. Right. So I think that's for all the reasons you're talking about, Jesse, right? That reflexivity, right? Once unemployment starts rising, people get worried, they change their behavior, corporations start changing their behavior, and then it, to a certain extent, becomes a self-fulfilling prophecy. So you've got to have a really good reason why this time is different right now, especially too, because, if you look at the chart of interest rates, which I could put up, it also tells a very similar story. It's a pattern of the Fed hiking rates, plateauing, and then realizing, oh my gosh, we held the rates too high for too long. And then as the recession arrives, it is panic cutting into the recessions, right? And that's why everybody always says the Fed is behind the curve. So where I'm going with all this, Jesse, is it sounds kind of like this is business as usual, right? I guess the only thing I'd say, just to give you a chance to comment on your answer is
Yeah.
I mentioned how the people have begun to say, well, it's different this time because the recession didn't arrive and the markets have done well. I think a big factor of that is multifactorial, but a big one has been all the liquidity that's been continued to be pumped into the system, even though the Fed has sort of taken a break. I mean, it's continued to draw down the reverse repo facility, so it's still been playing a role in adding liquidity. But we had, all of the fiscal spending that's been going on. And again, you can't do that forever too. That has a price. So are we coming to the point here where, hey, it's these same age-old patterns, Fed behind the curve, reflexivity kicks in with unemployment rate, and the fiscal magic can't persist forever?
I think that's absolutely right. And I think when you look back at previous cycles, the notion of a soft landing is a very common theme, right? People were talking about a soft landing in 2007. Housing markets started to peak and roll over in 2005, and everybody thought for a couple of years, wow, maybe there won't be any big problems, to arise after that. Same thing with the dot-com bust. NASDAQ cratered, and everybody thought, okay, wow, the economy didn't go to hell in a handbasket. Things are going to be okay. Maybe we'll have a soft landing, and that's kind of just a very common, I guess, thing to expect before the data becomes so bad that it's obvious that recession has already begun. And at that point, markets have probably already discounted that outcome. So that's kind of why I say right now, it's interesting to me to see the stock market begin to validate the idea that, we're maybe not headed for a soft landing. When you see utilities outperform the NASDAQ, when you see gold prices outperform the NASDAQ, and you see all these defensive stocks, Costco, outperforming the rest of the stocks in the QQQ, Walmart, outperforming. These are all signs within the stock market that, with defensives outperforming dramatically over the last couple of months, that something is changing, and the stock market is trying to price a different outcome than a soft landing. And the bond market has been pointing in this direction for a while, right? Bond market is, with the 2-year yield and expectations for Fed rate cuts over the next 12 months, bond market is screaming recession right now. And so, there's been a disconnect between stocks and bonds, but I think stock market is coming around to the idea that the bond market is right on the money here. And I would just point out things, in terms of consumer spending. Francois Trahan has pointed out that the restaurant performance index has plunged in a way that we haven't seen outside a recession. We've seen Ally Financial recently, big used car lender, talk about how they've seen rising defaults and delinquencies over the last couple of months. These are like real-time indicators, July and August, higher than they expected. And people are not just blaming cost of living now, they're blaming rising unemployment. And so this is a sign that this self-reinforcing deterioration in the labor market that Bill Dudley is kind of warning about is actually happening. And so I think it's, to me, especially interesting to see the stock market start to price this in.
What I find so fascinating, Jesse, is you're talking about how you are seeing signs in the stock market that it's beginning to price in something different than a soft landing for the reasons you just mentioned. But to like the casual observer, the S&P is like basically at all-time highs right now, right? As this is this recording, right? So it doesn't seem like there's a lot of worry going on, and even things like the unemployment rate. I think last report it actually ticked down, right? Didn't it tick down from 4.3 to 4.2?
Right.
So in historically, that's not a very high unemployment rate. It's not a worrisome unemployment rate. So there's still a lot of fodder there for people to say, Jesse, what are you talking about? Right?
Yeah.
Everything's great. Economy grew at 2.8% or maybe even more, I think, in Q2. And inflation's now coming down. It's a 2.5% headline CPI. What do you want, Jesse? We're almost at 2. Stocks at all-time highs. Real estate prices at all-time highs. So, yes, I agree. Looking under the hood, you and I, there's a river of data we can talk about that makes us really worried. But do you is this sort of like a Wile E. Coyote moment, I guess, is where the status quo is still hovering in midair. Gravity hasn't kicked in yet, but looking at the indicators, it's pretty clear that downward's going to be the next direction, or is there a way for this to be saved?
No, I think a Wile E. Coyote moment is probably pretty accurate. You're absolutely right. You need to look under the surface to kind of see what's going on, right? Headline unemployment number came down, slightly, but Liz Ann Saunders points out that 142,000 jobs were created last month. 527,000 new jobs were created for part-time workers, and full-time employment fell by 438,000 jobs. So the whole rise was in part-time employment, while you see people losing their jobs, full-time jobs in a big way. And so look at things like the underemployment ratio has gone from 7% a year ago to almost 8% today. And it did tick up last month. And that's just, driven a lot by people working part-time for economic reasons, that they have to take something part-time because they can't find anything full-time. So there's those kinds of things going on under the surface of the labor market. I would even point out with the jobless claims too, that those look like, oh wow, they haven't ticked up by any huge way. But we never really saw them spike massively in the 2001-2 recession either. And as Parker Ross points out on Twitter, that they're currently running, if you just exclude the 2020 pandemic year, continuing claims are running about 15-16% higher than the average of these non-pandemic years. 15% higher than you would expect, backing out that 2020 year relative to the other pre-pandemic or non-pandemic years. And if you look under the stock market, the message is the same. You have to look under the surface. So Stan Druckenmiller said, the best economist I know is the inside of the stock market, right? And so it's not necessarily what the S&P 500 is doing. It's what's going on under the surface. And that's why I talk about the relative performance of utility stocks. Look at the relative performance of retail stocks. It's terrible. I mean, they're hitting relative new lows. What are the retailers that are doing really well? It's Walmart and Costco are literally off the charts to the upside. And so it's consumer staples are outperforming, utilities are outperforming. And you're seeing a rotation out of semiconductors and out of cyclically sensitive sectors in the stock market. So I think that the message is pretty clear within the stock market and under the surface of the data that this idea that we're heading for a soft landing is now coming under serious question.
Okay, and just to make sure people watching understand the relative strength that we're seeing in sales at Costco and Walmart is not because the consumer at the lower end of the spectrum is doing a lot better and spending more. It's that the consumers from the higher end of the spectrum are now not able to buy at the big ticket brands anymore, and they're downshifting their expenditures to the more value conscious places like Costco and Walmart, right?
Yeah, yeah, and there's a great indicator that I have to give Jim Paulson credit for sharing recently. It's basically just the relative performance of Walmart versus the S&P Luxury Retail Index. And so when Walmart is performing dramatically better than the luxury stocks, it's always been a sign of recession. And right now, that ratio between Walmart to the S&P Luxury Index is literally as high as it's been at any point in the past 20 years in terms of the ratio. So it's another clear sign that luxury is really struggling. Walmart's doing phenomenally well. And that's actually been a really good indicator for when you've seen spreads, corporate spreads, other things that might make you worried about an oncoming recession. If Walmart wasn't outperforming luxury, that was a really good signal that we weren't headed for recession. So the fact that it is today is kind of confirming a lot of these other things to me is another just clear signal within the inside of the stock market that the economy is not headed for the type of soft landing that a lot of bulls have been hoping for.
Okay, and the general media, um, you know, likes to beat the bull drum for a whole variety of reasons, and in many ways, its interests are aligned in doing so. But to be fair, stocks are at all-time highs, and so I understand somebody still beating the bull drum to a certain extent. But it's interesting because on the day we're talking here, Jesse, we just got the August retail sales numbers, and they're being touted as a big beat, and the consumer is still hanging in there. And it's basically because retail sales increased by 0.1% when they were expected to have decreased. So it's like anything that's not complete disaster now is being sort of lauded as a win, right? It's
Right.
definitely not a strong growth rate. I don't know if retail sales are. I think they're reported on a nominal basis, and if they are indeed, well, then on a real basis, it's actually negative. But
Yeah.
it is funny that maybe funny in a sad way that they're just trying to find you know any silver lining to be able to tout that the bull market is still hale and healthy.
Yeah. Yeah. And if you just listen to, a good friend of mine, Eric Cinnamond, is the one, who does this better than anybody else that I know, but just listens to tons of conference calls. And when you start doing that and you listen, I think it was the latest Albertsons call, and they were talking about how for a long time now, the low end consumer has been really going towards like store brands and things and looking for ways to save money. But they're saying now they're seeing that middle market consumers and things starting to focus more on savings. And so you hear this like the dollar stores have all gotten crushed because the low end consumer is really struggling. But that's really an important data point there because it's the marginal consumer that kind of determines the trend in overall consumption. When the marginal consumer gets tons of money, put in their bank account from the federal government during the pandemic, right? And they go spend all that, and you get the huge, economic boom that we had, and followed by, a turn higher in inflation. It was that marginal consumer that made the biggest difference. Now that marginal consumer has shifted in the opposite direction, where they're consuming as little as they possibly can to try and shore up their finances. Another uh, great chart John Authors shared on Bloomberg recently was basically just the trend of consumption, versus income. And consumption's been outpacing income for the last 3, 4 years in a significant way. that can only go on for so long before those have to come back together, right? You can only outspend your income. At least us as consumers, right? The government can do it seemingly forever, but we can only do it for so long before we have to bring those back in line. And it looks like incomes are not going to catch up to consumption. And so consumption right now looks like it's starting to come back down towards incomes. And that's, typically one of the things you see at the onset of recession.
So uh, there's a bunch of indicators that I think are converging that support what you're saying. I'm going to put the rising unemployment to the side for a second, but I do want to get back to it. But just cost of living, right, has been, I don't even want to say creeping higher. It's kind of been still sprinting higher for a lot of people. In fact, just on Twitter yesterday, I put out the question, headline CPI is now 2.5% year over year. What would you say has been the growth in cost of living for your household over the past 12 months? And as you can imagine, people are coming back with much higher numbers. I'd say anything from 6-7% to 20-25%, for people. And so the longer that true cost of living, continues to outpace people's wage growth, you're hurtling towards a reckoning anyways, right? On that consumption versus income side of things. But then we also have, when you talk about the marginal consumer, which I love to always focus on the marginal player here, and I'm glad you're doing it. Yes, during COVID, they were artificially able to spend above their means because they were getting this, this free stimulus. And they had things like, forbearance on student loans and rent and all sorts of things, right? So another form of stimulus that's been happening in recent years is that American consumers have brought their savings rates down, right? Which has been an artificial stimulus to spending, which is just, hey, normally people save X%, they're just not this time for whatever reason. And so they've basically kind of been raiding their piggy banks. Again, that has an expiration on it. You get down to the point where the piggy bank's empty, you can't do it anymore. We've also seen people shifting an increasing amount of their consumption to plastic, to credit cards, right? We now, we saw those balances get paid down a bit in COVID, and then we saw them just shoot the moon to new record highs afterwards. And not for nothing, they're also charging record high APRs right now. So, all those things are conspiring to limit consumers' ability to consume. And then if we add increasing unemployment to that, it becomes almost this perfect storm that we seem to be hurtling towards.
Yeah. Hey, absolutely. And I think that's the trajectory that we're on. And that's why, Bill Dudley, former head of the New York Fed, says we are either approaching this tipping point or we've already crossed it. And I think that, like I said, that's what the market is starting to point out. I would just add some of the indicators that I look at most closely that are market-based indicators. We talked about, I think we last talked back in March, and I pointed out my 350s, which were, the insider sell to buy ratio on a 13-week trailing basis went over 50. We saw over 50 Titanic syndromes triggered over the New York Stock Exchange and the NASDAQ over a 12-month period. And the Magnificent Seven stocks were trading 50 times free cash flow. Those are all kind of still in those areas. And one thing I would just point out is that the 12-month insider sell to buy ratio, I think if there were one economic indicator that I would prioritize above everything else, it's what are the top corporate executives in the country doing with their own money? Because when you aggregate this, Najat Sehun's professor at business school, University of Michigan, and he's quantified this, and it has a really good 2-year lead on economic activity, on earnings, on all these things. And so the last time this 12-month ratio went over back in, I think, May or June, went over 25. So $25 sold for every dollar purchased among all of the top executives in the United States, corporate insiders. That's not including institutional holders, of course. Sometimes they're considered insiders, 10% holders, but this is just executives and directors at public companies. And so when it's gone over 25, the only time in the past decade that it has gone over 25 was in late 2021, right? And that was a very clear signal by these leaders of corporate America that earnings growth over the next 12 to 24 months was not going to be, not going to live up to analysts' expectations. The economy was going to slow materially, and we had a bear market in 2022. So insider sell to buy ratio came way down in 2022, came down to around low teens, around 10, which was actually a good buy signal, which I ignored stupidly. But it's back over 25 today. And that to me is telling me that corporate executives right now are saying over the next 12 to 24 months, economy is going to slow and earnings growth is probably peaked, and we're heading for another earnings recession over the next 12 to 18 months. And so that's one of the things that I think is most important in this discussion for me, because it's just one of the key indicators that I follow, and it's been quantified as one of the best. Stan Druckenmiller says the best economist he knows is the inside of the stock market. The best economist I know is the aggregated insider activity of all public company executives.
All
And
right, so that
they're
is
about as bearish as they've ever been right now.
okay. So what you consider to be perhaps the single biggest, most important indicator about the most bearish it's ever been. And sorry, you mentioned that there's a lag of when that peaks to when you see the earnings recession materialize. Remind me of what the duration of that lag is and where
It's
we are
about
in the.
12 to 24 months. When you overlay S&P 500 earnings with the insider sell to buy ratio, it leads by about 20 months. So a peak in the sell ratio will be about a trough in S&P 500 earnings about 20 months later. So we peaked a few months ago, suggesting that we're heading toward an earnings trough in about 18 months.
Okay, and that would be the trough of earnings. When does the market kind of wake up to this? Does it have to wait for earnings to trough, or is it when the descent starts?
Well, I'll come back to Stan Druckenmiller, right? I mean, he's the greatest hedge fund manager of all time. So Stan says, if you invest in the present, you're going to get run over, right? The market, you have to know what's going to happen over the next 18 months. What is 18 months in the future going to look like? Because that's what the stock market's trying to discount today. What will the future look like in 18 months? And that's why insiders are telling you right now, well, in 18 months, we're going to be down double digits in earnings. And so that's why I say it's fascinating to me to see the stock market start to wrestle with the idea of a hard landing, because we're just right now in this window where the stock market will start looking forward to this earnings trough 18 months from now and start to roll over and react to the earnings downgrades and stuff that are probably going to happen over the next couple of quarters.
Okay. All right. Well, I want to get to a couple of big questions here. One is, uh, we worry about the increase in unemployment because of the self-reinforcing elements that you mentioned. And I'm sure you're familiar with Michael Kantrowitz's hope framework, and the E is the bulwark that stands between the economy and recession. And so if that domino does fall over, it's kind of game on for recession, right? And that's dominoes looking weaker by the day for all the reasons you mentioned earlier. How does AI complicate the situation this time, right? Because it is hard not to see AI as a jobs killer to a certain extent. And I don't know if that's something that could contribute us falling into this faster or with greater velocity than we have in the past in terms of spikes in unemployment. And even if it doesn't, I think one can make the argument it's going to make the employment recovery a lot harder, because during this period that may be coming, the companies will continue their investments in AI and say, hey, how do we minimize the number of people we have to hire back?
Yeah. I think, where AI could really cause problems, I think, for the labor market, we really don't see it replacing jobs anywhere. Even the best application that I've seen for large language models and generative AI is in coding. And even professional coders will tell you that it really makes them more efficient, and that's probably one of its most effective uses. It's also very helpful at improving search results and things. And I love Perplexity AI, I think is the one that I use a lot, and it's helpful, but it's not really replacing jobs. I think what we're seeing is a lot of the data that I've seen is companies are testing this stuff out and realizing that, as the Goldman Sachs research report a few months ago suggested, that yeah, you can replace labor, but the investment required to do some is significant, several multiples more expensive than just keeping the people that you hired to do the jobs in the first place. And so the problem with the AI is that it's not reliable, one, and number two, it's so expensive that it probably in a lot of cases costs more than just hiring somebody to do the work. So but I do think where, and Ed Zitron has pointed this out. He's done some fabulous work on, from the inside of the tech industry on where we're headed with this stuff, is that the companies are spending, so big tech companies, Microsoft, Amazon, Google, are spending so much money on building out these data centers and on AI and NVIDIA chips and all these things, and the revenues are not materializing to support the investment. So they're going to have a choice. Either they're going to have to back off these investments in order to please investors, or they're going to have to start cutting other areas of their own businesses in order to continue to fund these things and not drive their costs through the roof to the point where investors say, "Hey, look, this is not worth it." We saw this with Meta, right? When Meta changed its name to Meta from Facebook and introduced the metaverse, and it was spent billions of dollars on the metaverse, and investors said, "Hey, wait, this is crazy. This is not going to make any money." And then so Meta went through their period of cost restructuring and things, and that really, they cut their costs and improved their profitability, and stock price rebounded. But they were forced, that discipline was forced upon them by the market. And I think we're potentially heading to another reckoning like that for all of these companies, where they're spending massively today, and they're either going to have to generate the revenues to support that. And I see zero signs of that happening right now, right? Microsoft can't sell Copilot, and that's really one of the only products out there that they're trying to sell. Adobe cannot clearly sell their any kind of AI upgrades. It's just there's not revenues there. And so what's going to happen is these companies are going to have to say, okay, we're going to cut back our spending, which is admitting that they've gone crazy overspending in a bubble, or we're going to have to start cutting other areas of our business. And then you might see more tech layoffs, where you see Microsoft cutting in other areas in order to support the AI. You see Amazon cutting, Google cutting other areas of the business in order to support the the AI and not let overall costs explode. So I think that's where we could potentially see some jobs become problematic, and that's really what we've seen so far in terms of the tech layoffs, is companies laying off in other areas of the business in order to fund AI.
Okay, so just to recap, you're not that worried about AI's impact on the unemployment rate, at least for the foreseeable future here, but you are, sounds like, quite concerned about the impact that the bloom coming off the rose of AI's potential to deliver transformative impacts to the income statement. And that when companies wake up to that, there's going to be perhaps a dramatic repricing, both a dramatic downshift of spending on AI relative to where we are now, and a dramatic repricing in the companies that have benefited from that dramatic spending. And those are mostly the AIs the Magnificent Seven companies with NVIDIA as the top of the heap, right?
Yeah, and
I guess
I got to give, sorry,
yeah,
go ahead.
Well, I was just
I
going
was going to
to
say, I got to give Ed Zitron credit for this. He put out a fascinating piece on, he called it the I think AI's subprime moment, and that's how he poses it, and I think that's probably right. Is that companies are either going to have to cut back on spending, or they're going to have to cut expenses in order to support the spending. So you could see some combination of both, but they cannot continue spending in the way that they are without the revenues materializing, and that's kind of where we're at.
Yeah, I'm glad you mentioned that, because I was just going to bring it up because I saw it on your Twitter feed here, Jesse. So I just want to read this one quote that you pulled out here. We're in the midst of the third delusional epoch of the tech industry. Yet, unlike crypto and the metaverse, everyone has joined the party and decided to burn money in pursuit of an unsustainable, unreliable, and environmentally destructive boondoggle. So obviously, he doesn't mince words. He then talks in this call out that you've screen captured here, that despite a lot of the hype around AI, we haven't found a killer app for it yet, at least certainly not on the consumer side. And that by kind of all accounts, the AI application so far in products has been, it can maybe be generously described as evolutionary, but we're not seeing anything revolutionary in there, despite the fact that there's been hundreds of billions of dollars funneled into the space over the past 2+ years. And I just want to give a note to Fred Hickey, publisher of the High Tech Strategist, who has been, I think, ringing the warning bell more loudly and for longer than I think almost anybody I know on this front, where he's just been saying, look, for the amount of spending that's been going in there, we're just not seeing for sure the incremental revenues, but even the incremental profits in terms of cost savings from this to justify what's been going on. And so therefore, it's really hard not to predict that there's going to at least be some sort of downshift in spending. And the question now, it just should be, well, how material is it going to be? And the risk here, as you know better than I, Jesse, is that those magnificent 7 companies that have reaped the vast benefits of the reward in terms of increased market value from the whole AI boom, there's a tremendous amount of market cap that has been inflated in those companies that's in danger of going away. And if that happens with those companies, because they drive such a material percentage of the major indices, the S&P, the NASDAQ, if those companies go down, they're bringing the indices down with them. And they are so overowned across the fleet of ETFs that are out there in the world that a lot of people have exposure to these companies that they don't even realize they have. They're in some ETF that doesn't sound like AI at all, but because of the structure of how ETFs are created and whatnot, there's a lot of exposure to these stocks. So you're nodding as I'm saying all this, but this is, I'm not saying this is going to happen, but if your worries do prove true and there's a material repricing of these AI stocks, that's going to be a real reckoning for the markets. I have a hard time seeing it not being one.
Absolutely. And I would just, I mean, you could look at Apple specifically, and Fred, I'm glad you give him credit for this. Fred has been all over these trends for a long time. And, Apple trades 35 times earnings. And a lot of that is because analysts have suggested they're headed for a new iPhone super cycle driven by, AI capabilities in the
Apple
iPhone.
Intelligence, that's the new AI, right? Yeah.
Absolutely, right. And when you look at, you watch the Apple's, presentations, it's like, okay, great. These are, as you point out, these are incremental things, but I don't think it's going to drive people to, want to upgrade their phones. I mean, everything that I read is the opposite. Is that, it used to be cool to stand in line for the new iPhone. Now it's just kind of a societal thing. It's cool to have the old beat up phone because it shows you don't necessarily prioritize the material. I need to have the latest and greatest. But Dan Niles, who's been one of the top analysts in the space for a long time, said, what drove Apple stock price recently was an anticipation that iPhone sales were going to be up 10% year over year after the introduction of the new model. Early indications are now that sales are going to actually be down 10%. So
Well,
if the if the multiple has gone to 35 in anticipation of a new kind of super cycle for iPhone sales, and it looks like the opposite is happening, you're absolutely right. There's a lot of room to downshift that. But I would just even point out that I just look at the top 3 stocks, NVIDIA, Microsoft, and Apple. And if you take their earnings estimates over the next 12 months, they've already peaked. Their year-over-year earnings growth has already peaked last quarter and is trending down, even on very bullish estimates for the next 12 months. Typically, when you see that peak in earnings growth, it also lines up with a peak in multiples. So, these stocks, like I mentioned before, trade 50 times free cash flow at a peak in their earnings growth rate. They're at the peak of the earnings growth cycle, and they're now rolling over. But even the bullish estimates, as I point out, are decelerating. So if those have to be cut due to things like this, Apple iPhone sales disappointing, then not only are we seeing a peak in the earnings cycle, but the downside of this cycle is going to accelerate. And so that doesn't leave a lot of room for stocks trading 50 times free cash flow to absorb those kinds of downgrades in earnings.
Yeah, absolutely. All right. Well, look, just given time, I want to start shifting into kind of the specifics of your market outlook and what assets you think may fare better given the times that you see coming ahead. But I want to preface it with a comment I got recently from a viewer, which was, Adam, I really enjoy your videos. I'm going to keep watching them, but I'm looking at the people that you've had on this channel, and a lot of them have been pessimistic about the economy and where the markets are headed. And the markets just keep powering higher. And Jesse, I totally get it. We're all looking through imperfect crystal balls here, and the market can remain irrational longer than we can remain solvent. There's that old adage there. But in your answer, what kind of advice do you have to the person that's just saying, like, when is this going to matter? Is it going to matter? Are we just better off just joining the party because we're just getting steamrolled here?
Yeah, that's such a great question. I mean, I've gone through this now. This is at least my third major cycle as a professional investor. I remember I was, co-manager on a short-only hedge fund in the late 90s. Talk about
Must have
pulling your
hurt.
hair out. There's a reason why I have no hair anymore. It was extremely difficult period, and wondering, oh my God, can this thing go any higher? And every time you wondered that, it did. Stan Druckenmiller famously, got so frustrated trying to short the dot-com bubble that he covered all of his shorts and went long right at the top in March 2000, right? And then he got destroyed when the market reversed to the downside and had to
That's the
take a
Isaac Newton
6 month
moment. Yeah.
sabbatical. He literally went to Africa with his family, like, I'm going to retire. This is too hard. And so you talk about that, and in all seriousness, Stan talks about he's dealt with just paralyzing anxiety through his career. These markets are not easy. It's not meant to be easy. It's meant to be extremely difficult and test you in every kind of way imaginable. I mean, from 2005 to 2008, it was a 3-year period where it looked like housing prices were rolling over from a clear bubble. And I mean, go back and watch, the Big Short, right? Michael Burry, literally going crazy because he knows things are going to have to go a certain way, but they just don't materialize that way. And even, when things are obviously becoming problematic and stock prices go up, the markets can drive you mad. I absolutely admit that. And I think we're at one of those points in time where yeah, a lot of this stuff is saying, I mean, I was going to point out too, we've had so many Hindenburg omens and Titanic syndromes triggered in the stock market this year. It's higher than anything we've ever seen before. So more than at the 2007 top, more than at the 2001 stock market top. And these are the only times you really see these types of things. And this is when markets are at all-time highs and you have tons of stocks at new lows, right? It's a very clear indicator of dispersion within the stock market, and that the trend is very extended. And we're seeing this again today, and actually on the NASDAQ, it's been off the charts. Like, it's so much higher than anything we saw in 2007, 2001, and even back in 1987. So yeah, I mean, these things can drive you crazy, but I do think that when you put them together, it's very clear that now is the time to be maximum defensive. Look at Warren Buffett, right? He's never had more cash at Berkshire Hathaway relative to the equity portfolio than he does today. This is the greatest investor in the history of capitalism, and he's never been more defensive than he is today. So I think that's kind of the picture, the macro picture that I want to paint. Is it's a very, very dangerous time for the average investor. But at the same time, Warren Buffett's not letting macro worries get in the way of making investments in things like Occidental Petroleum, right? You see Warren Buffett, you see Carlos Slim, Mexican billionaire, buying PBF Energy and Talos Energy, and literally buying hand over fist every day, day in, day out. You see, who's the owner of the Dallas Cowboys? just been buying. I just wrote this up as a trade idea. Been buying tons of Comstock Resources. Literally, he owns 70% of the shares outstanding now of a natural gas producer in the Southeast. So you have this, I think, opportunity in energy and in commodities today that is really very, very compelling and something I can get very, very bullish about at the same time. And it's honestly very reminiscent to me of this 2001 timeframe where you had blow off in the tech stocks and they reversed lower, and small caps and value stocks were just starting to take off, and they would outperform for the next decade dramatically. And so I do think there is a potential for rotation here into, and we're seeing it in gold, right? I mean, gold has already done fabulously well, over the last year, outperforming pretty much everything. But I think right now, commodities more broadly, especially energy, is so hated and so cheap that there's a real opportunity there.
All right. I did see on your Twitter account, you posted that chart most folks have seen about commodities value related to stocks, and they're still at kind of like all-time lows pretty much. So you think that that's going to reverse as we go forward from here?
Yeah, I absolutely do. So many people think that commodities do poorly during recession. Commodities do poorly in the lead up to recession. Once recession begins, what do commodities markets do? They start discounting what's 18 months going to look like. What's going to look like 18 months from now? Well, all the stimulus that comes during the recession is going to create a boom in demand for all those commodities. And so the oil price historically declines in the lead up to recession. Once recession begins, oil price bottoms and starts to take off, and already anticipate the coming stimulus that will drive demand for commodities. You also look at my friends at Investec have pointed out that the best performing sector 6 months after a major stock market peak is energy. And so major stock market peaks, rolls over. What's this number one sector you want to be in at least over the last 2-3 cycles has been energy. And so I think that's where we're at right now, is if you can be, I think, bearish on the S&P 500 and very bullish on commodities here. And that fits well with kind of the historical record.
Okay. In the intro here, I referenced your macro winds are shifting recent piece. In there, you had a couple of, I think you had 5 main points about sort of what you're looking at macro. One was commodities could outperform stocks from here. You mentioned that. You talk about how low correlations precede market corrections. We talked around some related things to that. One thing you mentioned, I just want to make sure I get clarity on here, is going forward, it seems like from a secular basis, you think we'll be dealing with higher inflation, higher interest rates, and higher volatility, correct?
Yeah, I think that's right. And I think that, this is something that Jamie Dimon has pointed out, right? CEO of JP Morgan. I highlighted a piece where Marco Papich talked about this. Jeff Curry had a fantastic interview in Barron's. It's interesting that there are people out there that are talking about these issues. They're just not getting any attention. And I'm trying to bring attention to these things because I think they have a really good point that, the combination of, deglobalization, of the greening, the green revolution, reindustrializing, our nation, for purposes of national security, redoing infrastructure. I mean, all these things are so bullish for commodities. I mean, just take AI, right? Even if you think AI, the spending is going to continue and whatever, and build out the data centers, you're
You have to power
creating
it.
such
Yeah.
massive amount, exactly, demand for energy right now. Literally, it's beyond anything we've seen for decades and decades. So how do you generate all that power? Okay, we're not going to go do it through solar and wind, because it's just intermittent. It's not consistent enough. But what we have is abundant, cheap natural gas, right? And so you're seeing, the amount of new natural gas power plants, be announced to be in the works is just growing so rapidly. And so, and then, copper producers talk about, okay, well, then that's great. You're going to generate all this power. How are you going to get the power to the data centers, right? You need transmission lines and all these things that are so copper intensive, right? And so the demand for all of these things, for energy, it's just, to me, it's a no-brainer. And the fact that people are so worried about the cyclical impact on commodities right now today creates a huge opportunity for those of us looking through that to the secular the secular trend, which is about as bullish as anything we've seen in our lifetimes.
Okay. So again, more validation for commodities performing well from here. Very quickly, higher inflation, higher interest rates, one might say, okay, that's not so great for bonds. But if you think we're heading into, at least in the near term, say next 12 months or so, rockier times in the market, maybe slowing economy, time for maximum defensiveness, what do you think about bonds in the relatively near term? Stay on the short duration end, or do you think there's opportunity on the long, or what do you think?
Yeah, I'm staying on the short duration end. I would just point out that, I mentioned Warren Buffett and Stan Druckenmiller. Buffett has famously bought zero coupon bonds when he's built a cash position. Today, he's completely in treasury bills. Why is that? Because I think he's worried about the fiscal situation. Stan Druckenmiller says he attributes the vast majority of the profits made during his career to trading the bond market. He's not buying long bonds. So when you have these two guys who are two of the greatest investors of all time, and typically would be buying bonds right now, long bonds, anticipating falling interest rates, they're not doing it. They're staying at the short end. I think that's a pretty clear sign. You know, the deficit is already so massive, and I think this is something that keeps me out of the bond market, at least, is that if we do go into recession and the deficit blows out even more, and the impetus is going to be to add massive stimulus, and what we've seen over the last 15 years is every stimulus package has to be bigger than the last. And if you think about the last one, it was
Oh,
so unbelievably massive that, okay, well, how do you do the last one? If we outdo the last one, inflation's going to the moon, and nobody's going to want to own bonds ever again. And so I think that's the risk. Is there, there could be 100 basis points of downside in long-term bonds, but there's a big risk to the upside in interest rates if we get and this is something else that Bill Dudley's been talking about, and I think we talked about last time we spoke back in March, was that Dudley's been talking about, we're going to have a showdown with the bond vigilantes at some point. We're going to have a Liz Truss moment here in the United States, and I think that's the risk reward equation for owning bonds is just not compelling for those reasons.
okay, which is why you say short end of the curve is better.
Yep.
Okay, last point on this, and then we'll wrap up. And we can just talk about this super briefly because we could probably do a whole show on this. But it sounds like you're saying that, for many assets, even if they're not fantastic assets, the price can get low enough that it becomes a great value. And right now, it sounds like you're saying that Chinese stocks might kind of be at a blood in the streets moment. Did I read that correctly?
Absolutely. I think if you think about one question I like to ask myself is, what's the most hated asset class on the planet, right? And I think today, I've said it's in the last few months, it's been either a tie, between energy or Chinese equities. And I think it's clearly Chinese equities today that, every Wall Street bank has called them uninvestable. And to me, that's usually a really good buy signal. They trade at ridiculously cheap valuations, and the Chinese economy looks like it could be in the process of bottoming and turning around. And if that's the case, then the stock market is just way too cheap. But especially, I'm interested in those big tech stocks in China, because you look at them compared to the U.S. They're comparisons, and they trade at a fraction of the price and have much better potential growth ahead of them. So it's an interesting opportunity, that I think is just the product of being the most hated asset class on the planet.
Okay. All right. Well, look, Jesse, another phenomenal discussion. For folks that would really enjoyed this and would like to follow you in your work between now and your next appearance on this channel, where should they go?
The FelderReport.com is my website. I try and put up a free blog post there once a week, just kind of highlighting a lot of the stuff we're talking about, things that I find of interest, charts and links and stuff that really kind of speak to me and that I think are maybe underappreciated by the mainstream markets and investors generally. And I'm fairly active on Twitter. Obviously, you already showed my my Twitter page. I try and I use Twitter honestly as a almost like a cork board, and just throw stuff
Mhm.
up as a way to okay, here's a bunch of ideas, and it helps me kind of see where narratives are trending in markets and what's driving prices, and so yeah, it's just at Jesse Felder on Twitter.
All right. And that's what I really value about Twitter is it really lets you peer into the minds, into the real-time thinking of the people who, you respect and want to know what they're thinking. So I appreciate you being so transparent on your X account for that. All right, Jesse, when I edit this, I'll put up the links to your website and your Twitter so folks know exactly where to go. Folks, the links will be in the description below this video as well. Well, look, folks, if you've enjoyed this and would really like Jesse to come back on as soon as his outlook tells him that anything might be shifting on what we talked about here timeline-wise, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And Jesse, to your point about being maximum defensive, I mention all the time on this program that most folks watching um, they don't have the experience of a Druckenmiller or a Buffett, and they have real lives and real jobs and families and things that they have to focus on. So in most cases, unless folks have a really solid track record of being a successful DIY investor, especially through rocky times like what you think might be ahead, I think most people are going to have better chances getting through that working with a good professional financial advisor who takes into account all of the macro issues that you've laid out for us here. So folks, if you're watching, if you've got it, if you've already got a good advisor that fits that criteria, fantastic, stick with them. But if you don't, or you'd like a second opinion from one who does, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the advisors you see with me every week on this channel. To do that, just go to thoughtfulmoney.com, fill out the short form there. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as possible position as prudently as possible for what may lie ahead. Also, just want to do a quick reminder that the Thoughtful Money Fall Online Conference is coming up fast. We're now just a month away from it. So the lowest early bird discount price that we've been offering is only going to be up for about another week or maybe just a tiny bit more than that. And I want to make sure that everybody who wants to go to the conference is able to lock in that lowest price. So if you haven't already bought your tickets yet, make sure you do so now. Go to thoughtfulmoney.com/conference, buy your ticket there. Also a reminder that if you are a premium subscriber to our Substack, you get an additional $50 off of the conference. So anyways, get yourself a $15 a month subscription to the Substack, get your $50 off, pocket the $35 difference. If you want to game the system that way, I am more than happy for you to. Like I said, I want everybody to get the lowest ticket price possible they can for the event. But it is shaping up, folks, to be an excellent event and now increasingly timely, especially given everything that Jesse just mentioned for us here. Jesse, it's been wonderful as always. Thanks so much for coming on. I'll let you have the last word. Any parting bits of advice for folks?
Just think about what defensive means to you, right? I mean, short selling is not for everybody. I actually don't recommend anybody try it. But I think to think about what is my most comfortable defensive posture in this type of environment is just a worthwhile exercise.
All right. Well, very well said. Thanks so much, my friend. Again, looking forward to having you back on in the near future. Everybody else, thanks so much for watching.